Okay, hi everybody. My name is Richard.lesperance. Welcome to A Better Lifestyle. Today I have the pleasure to have Christopher Swing with me. Welcome, Christopher, to the podcast.
Good morning.
Great. Christopher has touched different industries, so he has a lot of experience in different fields. But today we'll be talking about private equity. So he's pretty knowledgeable in that area. So Christopher, I'm gonna jump in right in the topic with the question. What is private equity and how is it different from the other like venture capital or an hedge fund?
Yeah, so private equity is the aggregation of institutional family office and individual investors. They pool funds together, gives a general partner the authority to make acquisitions on their behalf. And there's usually a fee structure where the general partners get, anywhere from 20 to 40% of whatever the proceeds of the fund are over a certain return. And basically, there's a tight timeline in which organizations acquire businesses and transact them. And this is all disclosed as part of the initial investment process. So, as someone who wants to start up a private equity fund, you may say, hey, we're going to return all of our capital in 7 years, for instance. Well, if that's the case, we know that you're not going to make all of your purchases in the first year, most likely. In which case, you need to think about how long you're going to be able to hold these assets and get a return on them with the ability to still execute on the expectation that you're going to return the money when you said you would. And so there's a lot that goes into, how to determine, what length of time your fund is. A lot of that is driven by your investors' appetite, depending upon which group of people that you're going after may affect the time horizon in which they're willing to accept it. And then there's also unique attributes within a private equity fund that's a little bit different than others, and that is there's a coupon rate that's given to the investors while their capital is deployed. And what I mean by that is a commitment that they'll make 8% before anybody else makes any money, or 10% or 12%, depending upon what type of fund, what type of industry, et cetera, that you're in. And then a lot of times what happens is a lot of private equity funds, once they get to about the midpoint of their fund life cycle, they're trying to return that capital so that way they don't have to continue to pay those funds. And so there's a process in which you're acquiring companies, and there's a process in which you're eliminating or selling those companies in order to try to balance the cash flows required of that fund.
Is that timeline, correct me if I'm wrong, between 5 years and 10 years?
Yeah, almost every fund that I've been around or invested in is in the 5 to 10 year timeline.
Okay. And what type of businesses do they go after?
So that's what's a little bit different about every fund. I mean, there are tons of these funds throughout the country and the world, though there's more in the United States than probably anywhere else. And there's a lot of different funds. The fund that we're currently owned by at Vantage Surgical Solutions is a specific healthcare fund, and they don't invest in anything else. There are lots of funds, though, that will pick like a size of business as opposed to an industry, and they'll say, "Hey, we're going to invest in companies that make between $5 and $10 million of EBITDA, or 2.5 and $10 million of EBITDA, whatever the appetite is that they're trying to attract." But there's an investment thesis around even those more generalized organizations or funds, and that here's what we're trying to accomplish. Here's what gives us the unique skill set as the private equity side of the business. And so this is what we're acquiring. This is how we know how to do what we need to do in order to double the value of this in a 5 year period of time. And then this is how we anticipate transacting it out and getting your money back.
What are the risks involved?
They're huge risks. These performances range anywhere, sometimes from the lower double digits to really high double digits, and a lot of that comes down to, are you acquiring the right business? Do you have the right technical skills? Do you have the right vision for what that organization can become? And can then you market it to that next group of funds? A lot of acquisitions that happen in the lower or the middle market of private equity. So you're talking like, under $100 million of EBITDA, for instance. Those funds have other funds that a lot of times will buy their acquisition after they've built it, because they've proven that they can build this vision and get the company heading in that direction, start to make some of those profits to make the money, to make the business worth more. And then those next groups can pick up where they left off and continue to grow it into that next tranche of what I would call a tranche of private equity funds. And so it just kind of depends. Some of these funds buy things so that way they can turn it out to an IPO. Some buy it so they can turn it out to another private equity fund, and sometimes they get bought by, strategics or public companies or other private companies that have some advantage to having that type of a business in their portfolio.
What are the different types of private equity? I think there's, if I'm not mistaken, leverage buyout. Is that correct?
Yeah. So depending upon your investment documents or the commitments of the investors, usually the private equity funds have decided what types of transactions that they want to do. Sorry. So some of those transactions include leverage. So they go out and borrow money against it. A lot of those transactions are when you've exceeded $100 million of EBITDA. That's probably the biggest transition period. And at that point, the bigger banks are willing to really lever those acquisitions. So what they may come with is only 20% of the purchase price, or maybe even less, by the time that they lever it up with a bank. A lot of times, though, the smaller funds will borrow money at the fund level. So they may use the commitments that they have from the investors, which are, solid commitments that they'll fund, when they have a capital call. And they'll either borrow money for the purposes of being able to transact faster and not have to worry about waiting for the money to come in from all their investors when they do a deal, or they may advance funds against some of their commitments in order to be able to lever some of those earlier deals and use less capital on them. So it just kind of depends. There's so many different modalities of how you can deploy capital, whether you use leverage, whether you don't use leverage. The other side of this is some private equity funds like to have owner investors roll a certain amount of equity that dramatically reduces their risk as they go in. And then how they structure the cap table also affects the amount of risk that the private equity fund is taking based upon that particular investment.
What about growth equity?
Yeah. So, that's kind of what I was talking about, is a lot of these will require some rollovers, and they do that for two different reasons. First of all, it gives the original investor the ability to sometimes 2, 3, and 4x what the return was from the initial purchase. But the second side of that is a well-positioned private equity fund will use their investment as more of a, like in my cap table, they're a convertible debt. And so they get, interest out first before the original investors can get any of their capital returned. And what that does is that really puts the majority of the risk in the business from a capital perspective on the original owners, because there's a big difference between going into a liquidation or a bankruptcy from a capital or credit side of the business versus being an equity owner, I guess would be the best way to describe it. And so they get the first money out, and they also get cash flow from the money in order to return the coupon back to their investors. So there's lots of different ways that can happen. And then also there are times where, most private equity funds will allow core investors or the investors that were the original owners of that business before they were bought, especially if they're the actual portfolio company that is going to be the holding company going forward, and allow them to invest along with the private equity fund as they make additional investments. And the reason they do that is so you don't dilute your equity along the way. Otherwise, every time you make an additional acquisition under that particular company, you get dilution for those original equity owners.
So what is the success rate when these firms buy these businesses? Because I'm pretty sure like not all of them go through or successful.
Yeah. So it's not great. And I'm not going to give you a percentage because I'd be lying to you. But I will tell you this, that the reason that the private equity funds that continue to raise more and more money every year is because they're successful. And so, when you're thinking about an investment in private equity, especially, you want to see the track record and you want to understand the experience of the operators, right? And so a lot of times we're really focused when we're dealing with the investment side, we interact primarily with the partners. But it's really more important to dig a little bit deeper, in my opinion, to understand the abilities of the operating people. And a lot of times those aren't really your partners they're overseeing those operations. They may be maybe making those decisions. But what you really want to see is, hey, do these funds have operating partners that have done this before? Whether that's they were in business and they were very successful, or that's, hey, these guys have come from private equity funds, maybe not this particular fund, but another fund, or maybe this particular private equity group has done multiple funds and they've successfully exited multiple times. That's the key, because what you're basically betting on is that not only can they find a good investment, but that they can visualize what the outcome of that investment is. They can make the correct strategic partnerships or investments along the way, and that they can execute on their strategy. And that's the difference between having a good CEO and having a not as good CEO. It's also the difference of having an operating partner that says, hey, what we saw in this guy with his business doesn't have the ability to transcend what they were doing. And we really have a vision that's much, much bigger than that, in which case they need to go out and find a CEO that can elevate that business and actually grow it into what they visualized it to be, assuming that that's even possible.
When they acquire those businesses, who do they sell those businesses to?
Yeah, so that's where it's a mixed bag. Some private equity firms really buy businesses with the intention of being able to sell it to another private equity firm. That's very common because there's lots of stratospheres of these private equity groups, right? So it goes from really small, like some may buy $1.5 million or $2 million of EBITDA. Some don't want to even look at you until you get to 50 million in EBITDA. Some don't want you until you're over 75 million in EBITDA. Some don't want you until you're like 150 million. And you think about multiples, right? Like think of Berkshire as a potential purchaser, which they don't really love private equity if you've listened to Warren much. But if you're Berkshire, they're not wanting to spend, at this point, less than probably a few $billions. So you really need a really sizable organization. Now, the benefit that those same entities have is where you're at in that stratosphere and at what industry you're in determines what multiple that they get. And a lot of times as they climb, the size of EBITDA scale. So let's say that you go from a $50 million EBITDA to 75 or a $25 million EBITDA to 100. Those have dramatically different multiples. So in a $25 million EBITDA, you may only get 6 or 7 times in a particular industry, and at 100, you may get 11. And so, as you grow, that value grows concurrently in kind of a exponential basis almost.
Before someone sells their business to a private equity firm, what should they think about?
Oh man, you need a really, if this is your first time selling to private equity, you need a great advisor. It's really important. And there's so many different things, so many nuances. Uh, as someone who had to sell, so I've always been on the purchasing side of private equity until this business, and I sold to private equity. I can tell you, we hired great legal, we hired great finance, just overall deal consultants. And there are so many nuances to a transaction and so many different ways to do it. And I don't know that there's a right way or a wrong way, but every fund does it a little bit different. And so you need to understand, like, okay, what does my cap table look like after this transaction? And am I rolling equity or am I getting all my money? What do they plan to do with the business that I'm selling them? Is this something where, I'm the portfolio and so I'm going to continue to run the business as we move forward? Or is it something where they plan to bring in somebody else to run this business? Do they plan to, add different product lines? Do they plan to, some organizations will take and they'll, go out and find whatever advantaged businesses that they feel like they could have an impact in, and they aggregate them together and they make like a GE out of it. If you guys remember years ago, Jack Welch just had these massive business that was just lots of random businesses, whether you're talking, jet engines or you're talking healthcare or you're talking locomotives. I mean, they were making everything. And so nobody had any idea. Finance, they had no idea how they were making money. They just knew as a conglomerate, they were making money. Understanding and having the same vision as what that private equity firm, especially if you're rolling equity, is very important. Understanding what the risks are when things go bad. Like, what does it look like? Making sure that you have a board seat, especially if you're rolling equity, because if you don't even have a seat at the table to be able to make a claim. And especially if you become the CEO and you don't have a board seat, and all of a sudden they're starting to have conversations around you because they're thinking about replacing you. Now you don't have any say in where that business goes after you've been replaced. So, I mean, I think the biggest thing is maybe even find somebody who's done it before. I have some great friends that I bounced ideas off of. We found great advisors. I think those are probably two of the biggest things to do. But then really dig in and make sure you understand what you're agreeing to, because when that document's done and everybody goes around the room and decides that, yes, we're ready to close, that's when the battle begins, because now you're working in an organization structure, a completely different legal entity a lot of times, and authorities change. All that stuff happens in those legal documents, and really understanding what it is that you signed up for, what you agreed to, and kind of what it looks like as you move forward and what your role is.
You've done some deals before, so what was your experience?
So it depends on how big they are. My experience was when we acquired Bird's Eye Vegetables with Blackstone, and there was a lot of confusion in that acquisition that we were merging these two companies. And that isn't what happened. Maybe from a legal perspective, they took and merged two big companies together, but the reality is that Blackstone was behind us, which was Pinnacle Foods at the time. And there was no question that we were taking over control of that organization after we acquired it. But I think because of the way that it was sold to the employees, there was a lot of confusion about that, even through the point of, we're there hiring staff to come on to Pinnacle Foods side so that way they can participate in the organization as it moves forward, and shutting down their headquarters. The employees still believed in a lot of cases that their leadership team that was helping facilitate this transaction was going to continue to be the leadership team of that combined organization. And that was not the case. And so I think really having clear expectations and communication when the transaction does happen goes a long ways, because what was happening was the employees were going to their previous leadership and asking for advice on how they visualize this to work going forward. And because they had already kind of sold them down a bill of goods, right? They just kept going down that path. And so they would say, we're not completely sure, but here's what we think will happen. And the reality was is they were asking the wrong people for the vision of the organization, because those people weren't going to stick around beyond the complete aggregation of this one company. And so I think, there's just a lot of nuances to watch out for. Now, granted, that was over $1 billion acquisition, so it's not the same as if you're a $1.5 million EBITDA business, but it's just really important to understand, what the organization looks like and kind of how it goes moving forward.
So if someone wants to start a private equity firm, what would you say to them, and what would be the step for them to take?
Yeah, so I think the biggest thing that I would do is first of all, I would have some experience in the business in which they want to operate, especially as the lead partner in a private equity fund. That's necessary. And I would recommend what they do is they go and find a group in Salt Lake called Fund Match. And his name is Bridger Pennington. I followed him. I like the information that he produces. I think there's a lot of valuable advice that can come there. And he's really helping kind of the everyday CEO or the everyday business owner, the person that wants to start a private equity fund but doesn't have that, pedigree, I guess, of Wall Street, that can really get these things started. I really think that if you follow the process and you do the work, that someone with a decent amount of experience in a particular business or industry, especially if they've operated successfully businesses in the past and transacted them, because there's a lot to that. There's a huge value in at least using him to understand what it is that goes on. And he does a lot of free content. And I think that's what's super valuable. And it will help some of your listeners to decide, hey, is this something that I could do? And if you get to the point where you're listening to him and you're like, there's no way I could do this, then it's probably not for you. I mean, this is not an easy thing to do. And a lot of it comes down to when you start, because depending upon how capital markets are doing, I don't know if you guys follow much in the way of how private equity funds and transactions are happening, but in the lower markets, private equity fund transactions are really down. In the really high end markets, over 100 million in EBITDA, those transactions are happening again. And so if you're trying to raise money from organizations and from investors that already invest in private equity, they know some of the headwinds that private equity is dealing with today. And so it's probably a little harder to raise those funds today than it will be maybe in 12 or 16 months from now. But it takes time to put all this together. So this is a great time to really get started. You can do all the work and figure out what your fund is and figure out what your business is, and put together a pitch deck that shows, here's what I'm really good at, and here's what my team looks like, and here's how I'm going to execute on this strategy, and here's why I'm different than everybody else. And doing that, I think you could, really be ready to rock and roll by the time that the markets kind of open up again.
From the legal side, what are the legal requirements?
Yeah, so there's a ton of legal requirements. You definitely need to have people who know exactly what they're doing in building those fund docs. You've got subscription agreements and things like that, and understanding how the structure of the business from the fund itself works, as well as how you're going to acquire businesses, et cetera. All of those things are disclosed in your fund docs, and whatever the fund docs say, you have to follow them like to the T. And so having a legal person after you've done this fund match stuff, which will give you a lot of the knowledge to be able to find what you need about private equity funds, you go and get an appointment with a really good attorney that can lead you through this process. I mean, you're talking probably $50,000 to $75,000 if you go out and find a decent named attorney and you've figured out all this stuff in advance. But they'll put you on a path that will not disappoint you when you go to do acquisitions, because if you don't follow your fund docs, you're in a world of hurt. You're in a lot of trouble. There's also lots of legal requirements. So like, I think in the state of Illinois, if you raise less than 150 million, you fall under state law. And if you raise over 150 million, you fall under federal law. That's going to be different everywhere. And to be honest, I haven't looked at those numbers for a couple of days, but I think that's what the numbers are. There's a lot of requirements on both sides, and just making sure that you dot your I's and cross your T's.
What are the different types of people that could invest in those deals?
Yeah, so there's different types of private equity funds, and depending upon whether you want to be able to market your fund or not, determines how much net worth or income annually that an investor has to have in order to be able to do that. There are some new laws under some crowdsourcing stuff that a private equity fund may be able to fall into. But there again, you just need to have an attorney that has really in-depth knowledge about those things, and make sure that you set up the fund with the right intentions. Like for instance, if you want to be able to market your fund publicly, then I think you have to have a qualified investor, which is $5 million of net worth or above. And it depends on the entity type. If it's an entity, then it can even roll to the investors in that entity requirements. So there's just a lot of legal nuance there. But if they go out and they do some research around fund match and things like that, they'll find out a lot of this stuff, and they can actually, and they provide a lot of forms and things like that where you can start filling in what it is that you would like your fund to look like, who you're going to raise your money from, and then make sure that you build a fund around those people. So like, for instance, if you don't market publicly, you just quietly market your product or your fund via institutional investors or meeting one-on-one with someone, then you can get down to where you only have to have $1 million of net worth to invest in these funds. Or I think it's like a certain income threshold. I don't know if it's, I don't know what that threshold is. It's like 250 or 300,000 maybe, or something like that. And so that makes it much more palatable. And therefore, I think a lot of people use that particular exemption to be able to raise funds, because it gives them the ability to raise funds from a more available investor than someone who has more than $5 million worth of net worth. The other thing is the requirements that come. So like, if you're raising from someone who's more than $5 million of net worth, you actually have to have them certified that they have that. Whereas if you're in the exemption where it's only $1 million worth of net worth, they just have to self-certify that they have $1 million of net worth. And so that hurdle is a lot easier, because the onus isn't on you or your due diligence to certify that they have those higher net worth amounts.
Where can people learn more about you and follow you?
Probably the best way to get a hold of me is LinkedIn, or you can go to my podcast, which is Faithful. And I have a web page there that will allow you to get in contact with me. I can give you my email, and you can drop it into the show notes if you want, and they can connect with me that way too.
What is the podcast all about?
So my podcast is about kind of faith and leadership combined. And being a Christian man, I feel like sometimes when we go to work, we forget our Christian roots and how that affects us if we actually intentionally lead with those core values in mind.